All right, folks, let's talk about buying a house. It's one of the biggest financial steps you'll ever take, and it's loaded with confusing terms. One of those terms you'll hear tossed around is mortgage points or discount points. What in the world are they? Put simply, mortgage points are fees you pay directly to your lender at closing. In exchange for this upfront cash, the lender gives you a lower interest rate on your loan. Think of it like prepaying some of your interest to get a discount on the rest of it. It's a trade-off, and like any trade-off with your money, you need to know if it's a smart one. So why would anyone willingly hand over more cash to a bank? The main reason is to lower their monthly mortgage payment. A lower interest rate means you pay less to the bank each month for the life of your loan. For people who plan to stay in their home for a long time, this can add up to some serious savings. It's the classic financial decision. Pay more now to pay less later. But here's the kicker. It only works if you actually stay long enough for the savings to outweigh the initial cost. We've seen too many people fall for the lower rate sales pitch without doing the simple math. Let's be crystal clear on this. One mortgage point costs exactly 1% of your total loan amount. It's not 1% of the home's price, but the amount you are borrowing. So, if you're taking out a $400,000 mortgage, 1 point will cost you $4,000 right out of your pocket. 2 points would cost you $8,000. That's a chunk of change that could go toward your emergency fund, new furniture, or paying off other debt. This isn't monopoly money. It's your hard-earned cash on the line. The discount you get for buying points isn't set in stone. A common rule of thumb, 1 point is about a 0.25% rate reduction. However, this can vary between lenders in the market. Some offer 0.25%, others 0.125%. That's why you can't just assume it's a good deal. Get the specific numbers from your lender and run them yourself. Don't trust someone else to do the math on your financial future. You have to take control of your own money. When you're closing on a house, you're already writing a big check for the down payment and a pile of closing costs. Adding thousands more for points can stretch your budget to its breaking point. Remember, that money has to come from somewhere. If you have to drain your emergency fund to pay for points, you're making a huge mistake. A lower mortgage payment won't help you when the water heater explodes and you have no cash to fix it. Being house rich and cash poor is a recipe for financial stress and disaster. The cost is a straightforward calculation, which is the good news. Let's use that $400,000 loan example again. If you decide to buy 1.5 points, you simply calculate 1.5% of $400,000. That comes out to $6,000, cash you must bring to the closing table on top of everything else. This isn't something the bank just rolls into your loan for free. It's a direct, upfront payment. You are essentially giving the bank a pile of cash today in the hopes that their small monthly discount will eventually pay you back. It's a bet on your future. Now let's look at how that cost translates into a lower rate. Option A, a mortgage at a 6.4% interest rate with 0 points. Option B, 5.75% if you pay 1 point, $4,000. Option C, 5.50% if you pay 2 points, $8,000. Seeing those lower rates can be tempting. Who wouldn't want 5.5% instead of 6.0%? But that temptation is a trap if you don't understand the true cost over time. The bank is betting you'll move or refinance before you ever see real savings. See this not as a discount, but as an investment. And with any investment, you need to know its return. If you pay $4,000 for a point, you need to know exactly how many months of smaller payments it takes to add up to that $4,000. This is the break-even point, and it takes less than 5 minutes to figure out. Option 1, 6.0% with no points. Option 2, 5.75% if you pay 1 point, $4,000. Use any free mortgage calculator. $400,000 at 6.0% is about $2,398 per month. At 5.75%, it's about $2,335. $2,398 minus $2,335 equals $63 per month. $4,000 divided by $63 is about 63.5 months, just under 5.3 years. If you sell or refinance in less than 5.3 years, you lose money. Stay longer and you start pocketing pure savings. This is where you take back control. Points are just one part of closing costs. Origination, appraisal, title, attorney fees, and more can add up to 2% to 5% of your loan. Ask for a loan estimate. Look at Section A for origination charges. This is where points are listed. Compare at least 3 lenders. A shiny low rate can hide higher junk fees. Examine the total cost to close. Points may be tax deductible, which can shorten break even. But tax laws are complicated and change. Your ability to deduct depends on your situation. Get advice from a qualified tax pro, not your lender or your brother-in-law. Don't build decisions on fuzzy tax math. Consider points only if you're 110% certain you'll keep the home and the mortgage well past your break-even. If break-even is 5 years, plan to stay 7 to 10 years. If you've got a healthy down payment, a fully funded emergency fund, and you're investing 15% for retirement and still have extra cash, buying down your rate can be reasonable. But cash is king. Don't give it up easily. Say no if there's any chance you'll move within 5 to 7 years. The average American does. Otherwise, buying points is like lighting money on fire. A gift to the bank because you'll move or refinance before you break even. If you don't have 20% down, focus on avoiding PMI first. Getting rid of PMI saves more than points. Let's bring this all home. The decision to buy mortgage points isn't about a magic formula. It's about being intentional with your money. It's a simple trade-off. Pay a lump sum today in exchange for a small discount every month for years to come. The only way to know if it's a win is to do the 5-minute math we walked through. Don't ever let a lender pressure you. It's your money, your mortgage, and your future on the line. Take your time and get it right. Here's your action plan. First, get loan estimates from multiple lenders, with and without points. Second, calculate the monthly savings. Third, divide the total cost of points by the monthly savings to find break-even in months. Finally, have an honest conversation with yourself and your spouse. How long will you realistically live in this house? If your stay is much longer than break-even and you won't touch your emergency fund, points might be a good move. If break-even is 8, 10, or 12 years, the answer is a clear no. Too much changes over that time. If you plan to move in 3 years and break-even is 5, it's a definite no. You'd be throwing away thousands. Always be conservative. Better to keep cash and have a slightly higher payment than gamble on an uncertain future. Remember, personal finance is 80% behavior and 20% head knowledge. You now have the knowledge to make a smart decision about mortgage points. The rest is up to you. Take control of your money, or it will control you. Do the math, have a plan, and make the choice that's right for your family and your future. You've got this. If this has been helpful for you, please like this video, share it with a friend who's buying a house, and subscribe for more common sense advice about your money.